Okay, so Rick, thanks for joining us for the quarterly update from the Adansonia Fund. Mate, you had another good performance this quarter, outperforming the benchmarks quite significantly, actually. So we 7.5% for the quarter against a benchmark of 3.7%. Another good
Yeah,
result.
yeah, no, thanks. Thanks very much, Rob. Happy New Year to you. Yeah, look, the fourth quarter was pleasing. Very much as you mentioned, we did 7.5% for the quarter versus the benchmark up 3.7. As I said, look, the market's just been in a very happy place. In fact, for the financial year or the calendar year, I mean, the fund delivered 34.9% against the market, 19.1% up in $8 terms, which is really an outstanding result for the market, sort of, heading into, well, basically delivering that into a very, very strong tightening cycle. But look, the market's basically just, as I said, we believe got a little bit ahead of itself over the fourth quarter. Part of what drove that strong result for the market is that the market went from an expectation of stronger for longer rates to that we're coming close to the start of an easing cycle, that rates will be cut, and just the combination of an outlook for a pretty resilient economy and that rates are going to start being cut soon, has just propelled the market to an all-time high anyway, sort of hit in January.
Yeah.
It was almost an all-time high in the fourth quarter. And we're just a little bit, we just believe the market's got ahead of itself, to tell you the truth.
I think the market was pricing in 6 interest rate decreases towards the end of the year, for the next calendar year. So that's
even now, sort of, pretty much starting from March.
Yeah, right.
If you sort of have a look at what yields have done, so 10-year US yields have fallen from 5 to a little bit over 4%. The market's trading on a P of 20 times. It's a 5% earnings yield. 10-year bond yields are a bit over 4%. We just don't believe that there's enough, that the risk differential is being basically properly represented in those two numbers. And again, a positive sort of commentary out of Taiwan Semiconductors, which we own for the portfolio, about they believe that next year will be good for semiconductor demand. Basically gave tech another leg up, which sort of drove us to an all-time high or an all-time close, record close a few days back. But again, it's a two-speed market, as we're largely seeing. Tech, I think, accounted for more than 2/3 of last year's return. The Magnificent Seven, I should say, not even tech.
Yeah.
So obviously that's just sort of shows you. But reporting season at the moment, Rob, has been relatively lackluster, and as we continue to tell our clients and you guys, is that our philosophy is that earnings growth drives share price growth, and earnings growth is coming through relatively to the low side, or, well, let's just say there's not a lot of positive surprise at the moment thus far with respect to expectations. Obviously, we are at the beginning. But inflation is having an impact on margins, and we're seeing the lowest margins in 3 years. And as I said, there's a lot priced into the market at the moment. So look, we've taken a little bit of exposure out of the market towards the end of, well, the fourth quarter. We ended it with about 6% cash. Basically, early in January, we sold down a little bit of Uber, which was up like 140% for the year. Taiwan Semiconductors, we reduced a little bit. MasterCard and Alphabet, Google.
Yep.
And we're now running 13% cash. Look, as I said, there's still great value there, and if what we'll probably end up doing is shuffling the portfolio around a bit, so really not adding more exposure to the market, but there are shares there which are showing a large degree of value, which have been sort of left behind.
Yes.
So we'll probably be shuffling things around a little bit and then deploying more cash, when we get a bit of a pullback. Again, the S&P 500 is around the 4,860 level, I think, like that. We wouldn't be surprised to sort of see a pullback to around the 4,500, about 5% or so. And then that should basically, probably, afford a better entry point. But at the moment, I think earnings seasons and outlook commentary is going to set the tone, and the market's in a very happy place, and we're just a little bit cautious at the moment with the outlook.
Yeah, well, I guess it gets back to, if the market's in a happy place, how can it get happier, right? What can happen to make it happier?
Well, exactly.
Yeah,
There's a lot of good news priced in.
yeah, exactly.
A lot of good news priced in.
Just interesting in some of my reading over the break there, the Magnificent Seven that you were talking about.
Mhm.
Collectively, the capitalization of those seven stocks is greater than all of the equity markets in Japan, UK, France, Canada, and Switzerland.
Yeah. Yep. Yep.
That's a lot of money.
Exactly. And those shares were, again, pardon me if I'm not exactly precise, but for 2023, those shares rallied between 50 and 240%.
Yeah.
I mean, as I said, it's there's seven stocks with, as you say, a large weighting in the market that's basically dragged up the entire market. I think last time we had this chat, we were sort of saying that the rest of the market was showing a degree of degree of value when you strip out
Yes.
the weighting and the multiples that these seven stocks hold. But again, we've had a little bit of normalization, and still tech is still really sort of driving things recently. And same sort of argument that, as you say, you take these seven shares out, and the market looks like a completely different beast.
Now, obviously you're an active manager, but to me that also demonstrates what I think the biggest risk is with passive investing.
Yep.
So at the moment, if you're investing in a passive investment vehicle, a very large chunk of that is going into these seven stocks.
Yeah, exactly. You're being basically you're being invested as a function of the size of the company, not the fundamentals of the company. And as we mentioned, some of these companies are trading at multiples of 40, 50 times. Um, as I said, it is a real fear. And on top of that too, one other thing we sort of spoke about, which is what we do, being an active manager, we're also a high conviction manager, where when you look at the MSCI World Index, 1,500 shares, the largest stock. I think it's probably coming. I think Microsoft might now be larger than Apple, but the largest shares, either Apple or Microsoft, are only 5 or 6% of the interior index. So you end up also getting a whole grab bag of shares with small to meaningless weightings as well. So
Yes.
one thing we do is we, as you say, we look at cash earnings, get comfortable, and then when we're happy with investing in the shares, we back ourselves and take a meaningful weight in these shares.
Yeah. No.
We buy them, we put in the portfolio.
Yeah, well, the strategy's performed wonderfully well again over the shorter term, but also more importantly over the longer term, you've performed well above benchmark.
Yeah, and look, thank you for that. Yeah, so since inception, which was actually 30 January 2019, so end of this month, end of January, we'll actually have 5-year numbers for the strategy, which we'll be very happy with. So we just under 5-year numbers, but yeah, since inception, we've delivered 15.4%, Rob, versus the index 10.3. So we've generated 5.1% compounding alpha over the life of the product. So we're very, very happy with it. Not saying it's sustainable, but look, I think we've been using this approach for a long time, not just with this product, but in past funds. And we're very happy that we believe that the investment approach works, and also that we can basically drive it. So we're very happy with the way the portfolio is tracking, and also just very happy with the support we've gotten from the Shartru network. So thank you there also.
Yep, no, not a problem. It's a pleasure to have you on the being able to give our advisors and their clients access through our MDA. You've done a great job. So great work.
Rob. Thanks, Rob. We'll do our best to keep it going. But
absolutely.
So
all right, Ric. Well, mate, thanks for giving us that update, and keep up the good work. And we'll talk to you next quarter.
Yeah, thanks very much, Rob. And as I said, I'll be back online with the regular sort of portfolio updates each quarter as well. So anyway, happy New Year to all, and fingers crossed that we have a happy 24.
Yep, and to you, Ric. Good on you, mate.
Thanks very much, Rob. Have a good day.